Hi, and welcome to Random Rogers Big Picture for the week of June 10th. Just one thing on the agenda this week. A reader left a comment asking a question that I said I would make an attempt to answer with this video. So with that, the question. Roger, I suppose your goal is to miss the meat of a severe downturn, but do you have in mind absolute figures of how much of a max drawdown percentage-wise? Pull up a 7-year month chart of the S&P 500 with 20-day MMA. If we break that line, oy vey. Okay, and then he goes on to ask Tom K a question and says something about stop orders. Okay, so putting a number on an absolute max drawdown. Okay, the way I read the question, I think the person is a little shorter term oriented than I am. Not necessarily a bad thing, and that observation may not even be correct, I'm not sure, but that's kind of what I perceive. So I'll answer this as best as I can, but this probably won't be that comfortable. Okay, first a quick word about how I start to get defensive, what that looks like. Really, the trigger point, the most important one, is for me, is the S&P 500 going below its 200-day moving average. Now, I should note that this has happened, I believe, 3 times in the last few years, and they've all turned out to have been head fakes, which is okay, pursuant to how I take action. But there's something to keep in mind, and it's going to underscore why you shouldn't make huge bets. But basically, when the market goes below its 200-day moving average, again defined as the S&P 500, okay, let's say it does that on a Monday. The following day, if the market is up and closes back above the 200-day, then I don't do anything. If on that next day the market is lower, then I would take some sort of defensive action. I can't quantify it for you. It just depends on what's going on, but I would do something on that day. I might sell out an entire position or two. I might take 2 positions or maybe 3 positions and cut them in half. I'm not sure. But take some sort of action right away, pursuant to being disciplined, and then sort of see what happens. Now, the idea behind being gradual about this, and if you've been reading the site for any length of time, you know I tend to be gradual with just about everything, is that, and this is something I've said on the blog before, think about it, the market averages 10 or 11% a year, or whatever number you can find. That takes into effect all the great years and all the lousy years and everything in between. So here the point is, if you miss every big downturn in the market for your entire life, there's a good chance you'll average 10 or 11%. Okay? If you've plugged something in, if you've built a financial plan for yourself and have assumed some sort of a growth rate, and you have an average number of something for the stock market for your returns, okay, well, that factors in the, not missing the bad years. Now, obviously, I am trying to miss, just as the person says, the meat of a downturn. I may be successful, I may not. That's beyond my control. All I can do is be disciplined to what I tell people I'm going to do, which is when the market goes below its 200-day moving average, take a little bit of defensive action, not, complete upheaval within the portfolio. The reason for that is if I'm wrong, which has been the case the last 3 times in the last, I think it's 4 years, but whatever, it doesn't matter, it's been 3 times, then the consequence of being wrong is not dire. If the market then goes down a little bit further, and doesn't show signs of turning around, then I would again repeat a similar action. Perhaps, maybe this means adding a little more to the double short fund. It may mean selling a little bit more. Whatever. The point is having less net long exposure with each increment. And basically I would just keep doing that. I can't really envision a scenario where I would sell more than half the stocks I own. It would be more efficient, I think, to let the double short position build up, either by adding more, or as the market goes down, the double short position obviously gets larger, and so it hedges more and more of the portfolio. But I don't want to really cause complete upheaval because, just thinking about what's normal, okay, there'll be a bear market again. The market probably will be down 20 to 30% when that happens. Then the bear market will end, then a new bull market will start. And so I don't want to make huge bets and miss all of that. If the market drops 30%, if I can miss, half of it, and I don't even know that I would, but if I can miss half of it, that adds a lot to the average annual return over a lifetime. That is pretty substantial. Even missing a third, and I'd like to think I could do that, but who knows? To be clear, who knows? But that starts to add up in terms of compounding. But, part of the thing here is the market goes down a little sometimes and it goes down a lot sometimes. And I'm just flat out not the least bit concerned about down a little. I'm hopeful that I can miss chunks of down a lot, but if I can't, if I somehow mess it up, which obviously I'm trying not to do, but if that happens, what supports that is that over time, if you've got a long time horizon, the market does in fact work its way higher. It does, as we've seen, the S&P 500 has now made back what it lost. It's powerful stuff. But you got to give it time. You have to be patient. You can't get emotional. You can't freak out. You can't succumb to emotion when things are hitting the skids. You need to map out a plan for yourself. But to answer this person's question directly, a max drawdown, no, I don't have one. Part of the way I think is you can only take what the market gives you. If the market gives us a 30% decline, or I should say, the next time there is a 30% decline, I'm hopeful that I'm going to miss some of it. And that's as good as I can do. The fact that I've got a simple plan, already spelled out, makes the task of navigating it a little easier. It doesn't ensure that I'll be any more right, but it does make it easier to do emotionally. It's like, oh crap, the market's down, whatever it's down, just dust off the old piece of paper with the, metaphorically speaking, the old piece of paper with the plan on it, and just stick to the plan. Just reduce slowly, reduce exposure, increase double short to offset, whatever, just reduce net long exposure. And do it slowly in case I'm wrong, I don't get whipsawed. If I get whipsawed, in spirit, if that's a great way to phrase it, then the consequence is not so great. I'll lag a little bit. Big deal. If I went 100% cash the day after we closed below the 200-day, that could be a real problem on all sorts of levels. Commission, taxes, on and on and on. So that's what I'm trying not to do. Hopefully that makes sense. I know it's not the answer that the person was looking for, but that is how I approach it. Have a great weekend.